Good day, everyone. We've just entered the new financial year, but still got to close the previous one though. So close on the heels of our last InSync episode, where we introduced the new amendments across regulators and financial reporting considerations. Once again, we have with us CA Vishal Divadkar, Partner and Head Audit and Assurance, MSK and Associates, Chartered Accountants, with important reminders for year-end reporting. Thank you, Vishal, for being here, and over to you.
Thank you. Welcome all to another episode of InSync. Following our theme for the series, we continue to focus on financial reporting matters for the year end, particularly as economies around the world enter a new phase of uncertainty. There is increasing pressure on businesses to provide transparent and accurate information to the stakeholders through their financial statement. Of late, we've also seen regulators increase their vigilance on the behavior of corporates and on the quality and transparency of corporate financial reporting. Whilst there haven't been significant wholesale changes to India's over the past year, we've tried to sort of capture some of the key aspects that we believe would be relevant from the perspective of the current year financial statements, given the economic environment that we find ourselves in. So, in terms of contents for the episode, along with financial reporting matters, we will highlight how the effect of inflation has a bearing on financial statements, and also touch upon a few relevant expert advisory committee opinions issued by the Institute. Given the focus on disclosures, the Institute has issued the India's disclosure checklist to facilitate proper presentation and disclosure in financial statements. So the macroeconomic factors today are having a far more wide impact on business and financial reporting than ever before. While we'd like to believe that COVID is behind us, there are other economic developments. The ongoing Russian-Ukraine war and its consequences on trade embargoes and sanctions, the banking crisis, the rising inflation, supply chain disruptions, etc. Closer home, we had the recent budget announcements, the weakening of the unstable rupee, and a large current account deficit, which all have a bearing on businesses and how they report their results in their financial statements. This uncertainty results in numerous financial reporting complications, such as the impact on entities going concern, impairment risk on carrying value of assets, redesignation of financial assets due to changes to business model, reassessment of control due to trigger of certain clauses in SPA terms, and other significant judgments and estimates. So I intend to discuss some of these financial reporting matters that need to be kept in mind by corporates and professionals as they look to close their financial statements for the current year. So starting with perhaps the most significant aspect that relates to financial statements, the fundamental assumption of going concern. As we know through a large number of corporate failures, this assessment by management and auditors is often questioned. Going concern is in a way drawing a picture to the world of the future of the company and its viability, which in today's times has become hazy for many businesses. Specific responsibilities are cast on the management as well as the auditors to throw light and report on this important assumption. Such situations require detailed disclosures in the financial statements and may have an impact on the audit report as well. Therefore, assessing a going concern assumption at an early stage during preparation of financial statements is important so that its impact can be adequately addressed, explained, and reported in its best manner. While the requirements of Ind AS 1 are not prescriptive as to how management's assessment is performed, some clear triggers are likely to be an increase in the events and circumstances which may cast doubt on a company's ability to continue as a going concern. While this may have been a routine assessment every year for most corporates in the past, the post-pandemic period has significantly aggravated the need for a lot more detailed analysis by both management and auditors. Due to the deteriorating economic conditions and geopolitical uncertainties, many entities have experienced a significant downturn in revenue, rising costs, or at times both. Many entities operating in areas affected by Russia's invasion of Ukraine were required to shut down or significantly scale down. Rising energy prices have contributed to stress on operating margins for energy-intensive industries. A rising debt burden on account of rising interest rates may be difficult for some high-leverage entities to sustain. Entities may not be able to pass on the rising operating costs resulting from high inflation to its customers. Factors such as these require greater attention to be paid to an entity's assessment of going concern. Index 1 states that management may need to consider a wide range of factors relating to current and expected profitability, debt repayment schedules, and potential sources of replacement financing when assessing the entity's ability to continue as a going concern. Historical information may not be a basis anymore. The focus is on liquidity, and it also requires management to consider all available information about the future, which is at least but not limited to 12 months from the end of the reporting period. Some national regulations require management to consider 12 months from the date that financial statements are authorized for issue for its going concern assessment. Consideration of a longer period is not inconsistent with the requirements of Ind AS 1, which sets out only the minimum period. Regardless of the period, one must note that the assessment of the appropriateness of the use of going concern basis needs to extend up to the date on which financial statements are authorized for issue. In the current economic scenario, circumstances are changing rapidly, and management is therefore required to update its going concern assessment to reflect the changed environment. The slide highlights some of the key areas that form the basis of going concern evaluation. So this table summarizes where companies may end up at the end of their going concern assessment. We believe scenarios 2 and 3 is where a lot of companies may end up, i.e. there are significant doubts, but there are mitigating plans from management which supports the going concern assumption to be appropriate. But where material uncertainties remain, these will need to be disclosed adequately. Entities are required to also disclose the significant judgments, assumptions, and sources of estimation uncertainty involved in the going concern assessment. Overall, the disclosure should be company specific, sufficiently granular, and both quantitative and qualitative. Boilerplate disclosures should be avoided. So moving now to how the going concern assessment could be reflected in audit reports. The auditor reports could now explicitly highlight the going concern aspects in various ways. Either as a key audit matter, if the auditor identifies events and conditions that may cast significant doubt on the entity's ability to continue as a going concern, but concludes that no material uncertainty exists, and also that the disclosures related to those events or conditions are adequate in the financial statements, the auditor may consider inserting a key audit matter in their report. However, when the auditor concludes that the use of the going concern basis of accounting is appropriate in the circumstances, but a material uncertainty does exist, the auditor should also determine whether the financial statements adequately disclose the matter and also management's plan to deal with the event or condition that gives rise to the material uncertainty. When the disclosures are adequate, an unmodified opinion would be issued, but the material uncertainty section should be included in the auditor's report. The description of the material uncertainty is required to be made under a separate paragraph titled Material Uncertainty Related to Going Concern in accordance with SA 570. However, if adequate disclosures about material uncertainty is not made in the financial statements per the auditor could express a qualified or an adverse opinion depending on the pervasiveness of the matter to the financial statements, i.e. with respect to the inadequacy of disclosures. And of course, if the going concern basis of accounting is itself concluded to be inappropriate, the auditor would issue an adverse opinion. The IAASB is currently working on a project to revise ISA 570 with respect to going concern. In revising the standard, the board is aiming to clarify a few aspects such as defining the term material uncertainty more clearly and providing clarity for other terminology used in the standard, for instance, significant doubt. It also is aiming to change the period of auditor's evaluation of management's assessment of going concern to at least 12 months from the date the financial statements are approved, rather than from the 12 months from the reporting period as it currently stands. There could be new requirements for the auditor to evaluate the intent and ability of a third or related party, including the entity's owner manager, when financial support or comfort letters are provided by such parties to support management's assessment of going concern. There are other aspects that the board is also contemplating clarifying as part of the revision to the standard. Needless to say, it is imperative that companies make full and transparent disclosures with respect to going concern in spirit, especially where significant judgment is involved. For instance, disclosure of the period of the going concern assessment and explaining the reasons for selecting such period. Disclosure of entity-specific granular information to enable users to understand how the entity plans to meet its foreseen liabilities over the going concern assessment period. Discussion of the effect of any post-balance sheet liquidity event. In case of reliance on government support, disclosure of the nature, timing, and extent of such support that is assumed in the assessment of going concern. Disclosure of clear and quantified assumptions with explanations as to how the assumptions have been determined. Giving sensitivity assessments of multiple scenarios and the disclosures around the assumptions as well, and so on and so forth. Similar to going concern assessment, the impairment risk needs to be assessed across asset classes. Goodwill, intangible assets, non-current assets like PP&E, financial instruments, and others like investments, deferred tax assets, and mineral resources. Let's look at each of these separately. So, with respect to goodwill and other non-current assets is covered under India's 36. The current deteriorating economic situation and the effects of the current geopolitical situation have increased the risk of impairment over non-financial assets. Entities should exercise greater caution with respect to impairment if the entity is significantly affected by factors such as high energy consumption that may be adversely affected by the rising energy costs, significant exposure to supply chain stresses, significant increases in costs on account of inflation, etc. All these are indicators defined under India's 36 that trigger an impairment test. India's 36 looks at goodwill and intangibles to be tested annually or more frequently if required. Moreover, for non-current assets, there are indicators to prepare more detailed cash flow workings as well. The standard clearly talks of methods of valuation that could be used. The value in use or the fair value less cost of disposal. Value in use means estimating future cash flows. This is done using two approaches typically. The traditional approach, which is the most likely cash flow approach, or the expected cash flow approach, which uses multiple probability weighted scenarios. In the current economic scenario, using the expected cash flow approach makes more sense. A fair value less cost method involves looking at a market participant approach in accordance with Ind AS 113 on fair value. Both these involve a high element of subjectivity and multiple scenarios would need to be modeled. Using external valuation help as an expert is not uncommon. While there could be clear impairment triggers, it would be a challenge for companies to estimate future cash flows with certainty. Key assumptions such as discount rates would need to be revisited due to the heightened risk environment. We would look at some of these factors in the subsequent slide. So we spoke how discount rates are important. Also, other inputs used for VIU calculation should be consistent with information disclosed elsewhere in the financial statements. For instance, business factors such as potential reduced customer demand, increased costs, other factors that may affect the business in the current environment, which typically is disclosed in the MD&A sections of financial statements. Key assumptions should extend beyond just numerical inputs, and also should explain how the assumptions made by management affect such numerical inputs. Explanation of sensitivities of recoverable amounts to changes in assumptions. This is particularly important where the range of possible outcomes is wide due to the heightened uncertainties. Explanation of the composition of cash generating units as defined under Ind AS 36, and the basis of allocation of goodwill and other assets to the CGUs or the group of CGUs. Moving to impact on financial instruments covered under Ind AS 109. Again, due to the economic uncertainties, there is risk of impairment of financial assets along with other issues. For example, expected credit loss may increase due to an increase in both probability of default and the loss given default for financial assets. As all financial assets are subject to ECL, require the PD to be estimated over the next 12 months, the effects of the volatile economic scenario may trigger a significant increase in credit risk and therefore the recognition of a lifetime ECL provision on many financial assets. Lenders and borrowers may enter into agreements to modify the terms of financial instruments like loans. Example, reduced interest rates, modification to payment terms, and grace periods for covenant violations. Entities should consider carefully the requirements of Ind AS 109 for modification of assets for lenders and liabilities for borrowers. These modifications generally give rise to gains for borrowers and losses for lenders. Financial stress at the recipient of financial guarantee contracts may trigger re-evaluation of whether a liability or a provision needs to be booked in the guarantor's books, especially where cross guarantees are given to related parties across group entities. If due to an operational disruption, a highly probable forecast transaction is not expected to occur, hedge accounting may need to be discontinued prospectively. This will require reclassification into the income statement of all the accumulated gains or losses on the hedging instrument. Moreover, derivative accounting in general for any sale or purchase transaction would need to be reassessed, and there could be a sudden decrease in volumes. Few other considerations with respect to Ind AS 109. Financial assets which are fixed rate debt instruments classified as fair value through P&L at inception or through OCI would experience a decrease in fair value in rising interest rate environments. Entities may wish to reclassify such financial assets into amortized cost measurement category to avoid recognizing such decreases in value through their income statement. However, reclassification of financial assets under Ind AS 109 is permitted only in case there is a change in business model for managing those financial assets, and this is expected to be occurring rarely in practice. Moving to disclosures, entities should disclose the methods used to measure exposure to risks and any changes from previous periods, any hedging instruments put in place to fix interest rates or hedge against effects of inflation, where material sensitivity analysis should be provided for the entity's exposure to interest rate risks, commodity price risks, and related liquidity risks, including a description of the methodologies and assumptions applied and the changes from previous periods. Along with Ind AS 36 and Ind AS 109, there are certain specific standards that deal with different types of assets. For instance, Ind AS 106 for exploration and evaluation of mineral resources. Given the decrease in global commodity prices, significant impairment of exploration and evaluation assets is expected. Before applying the equity method, an entity must recognize the expected credit loss in accordance with Ind AS 109 if an investment in an associate or joint venture includes a long-term interest which is subject to ECL, for example, a loan to the investee. After an investor has recorded its share of income from an associate or JV as required by the equity method, the remaining carrying value of the investment is still subject to further impairment testing. An entity can then apply Ind AS 36 to the remaining carrying value. Once the carrying value of an interest in an associate or JV is reduced to zero, additional losses and liabilities are accounted for if the investor has a legal or constructive obligation to make payments on behalf of such associate or JV. The effects of the current economic environment may make this type of arrangements more common. Similar to an assessment of going concern, an entity needs to assess whether it can recover the value of deductible temporary differences, considering all available information. Given the disruption to operations, forecasts may need to incorporate extremely severe downside forecasts. Tax losses and other temporary differences having no fixed expiry or a very long-term expiry are not justification for the recognition of associated deferred tax assets. Another area in the financial statements that is prone to volatility is fair value. Valuation was always a subjective area, and in these times even more so. Fair value is an exit price in an orderly transaction. The effects of the COVID virus and the macroeconomic situation may make it even more challenging to estimate the price that would be obtained due to such volatile markets and or the lack of existence of an active market. To a certain market participant view in these cases may not always be straightforward. For financial instruments with level 1 prices quoted on an active market, even if there is a significant decline in activity, this does not necessarily mean that the price can be treated to be not observable. But the level in the fair value hierarchy for inputs into fair value measurements may shift from, say, level 2 to level 3 with associated enhanced disclosures. Moving to events after the reporting period, an entity needs to determine whether the events after the reporting period are either adjusting events, which provide evidence of conditions that existed at the end of the reporting period, or non-adjusting events that are indicative conditions that arose after the reporting period. At times, this assessment could be subjective and involve significant judgment. Amounts recognized in the financial statements are adjusted to reflect material adjusting events. For material non-adjusting events, the entity should disclose the nature of the event and the estimate of its financial effect, or a statement to the effect that such estimates cannot be made. In times of uncertainty and rapid change, there's an increased risk that a material event will occur after the reporting period but before the financial statements are authorized for issue, making this assessment a critical one. Entities should monitor and continually assess to identify events and account for material events after the reporting period. There needs to be sufficient processes and controls to ensure these events are captured. In a quickly evolving economic environment, an entity situation may deteriorate significantly after the end of the reporting period, such that the going concern assumption could no longer be appropriate. The effect of the going concern assumption not being appropriate is so pervasive that the standard requires a fundamental change in the basis of preparation, and an entity shall not prepare its financial statement on a going concern basis, even if the events resulting in this conclusion took place after the reporting period. As mentioned earlier, the changing geopolitical risks, entities may need to reassess control, joint control, or significant influence over their investee companies, especially if these are located or affected by Russia's invasion of Ukraine. For example, the effect on investee of measures taken by Russia, such as nationalization of assets, clauses in contracts to dispose of interests in other entities, such as clauses that indicate call options to buy shares or deferred payments. In such situation, the entity should provide detailed disclosure concerning any changes made to their assessment of control, joint control, and or significant influence, and whether they consider that control, joint control, or significant influence has been lost. Whilst we have touched upon most of the key areas that could be impacted on account of inflation, we'll quickly also cover certain other impacts. Ind AS 102 on share payments. Inflation may have other macroeconomic effects such as lowering demand for goods and services. This may affect an entity's performance and have a corresponding effect on share-based payments with performance conditions. Ind AS 109 we've touched upon. ECL computation could be impacted. Inflationary clauses in contracts could kick in. With respect to leases, variable lease payments dependent on inflation or other price indices. Example, the CPI would require measurement as a result of rising inflation. Inventories. Inflation may lead to increases in estimated costs necessary to make the sale. If the estimated selling prices do not increase correspondingly, for example, in the case of long-term fixed contracts, this may lead to a reduction in net realizable value and possibly higher inventory write-downs. With respect to employee benefits, inflation affects actuarial assumptions used in the measurement of defined benefit plans and other long-term benefits. Higher discount rates may be required for actuarial evaluations. Assumptions of future salary increases may need to be reassessed as a result of inflation. Next, we move on to certain recently issued expert advisory committee opinions by the Institute. So these are a few select ESC opinions which we believed would widely impact most of the audience. So starting with the non-reversal of impairment in case of impairment of investment in subsidiaries, the committee was of the view that generally when an impairment provision is recognized against goodwill on consolidation of a subsidiary in the CFS, the carrying amount of the parent company's investment in the sub should also be reviewed for impairment, since it indicates a decrease in value since the acquisition, and thus is an impairment indicator. However, it should be noted that the criteria and the methodology for impairment in separate and consolidated financial statements is different. Hence, it was also concluded that the non-reversal of goodwill impairment as prescribed under the standard doesn't justify a similar non-reversal of a subsidiary impairment in the parent company's financial statements. Moving to accounting of borrowing costs, where the ESC believed that the borrowing costs incurred on the acquisition of shares of a subsidiary company in a secondary transaction should not be capitalized either in the separate or consolidated financial statements of the company. The company noted that the funds paid by the company in this case were not directly used for the acquisition of the oil and gas project under development. Rather, these were used for the acquisition of shares, which cannot be considered to be a qualifying assets, as these do not take a substantial period of time to get ready. Accordingly, the borrowing cost on acquisition of shares of the subsidiary should not be capitalized in separate financial statements. Moving to capitalization of insurance premium in case of construction projects, the ESC observed that the insurance expenses can be considered as directly attributable expenditure to bringing the project to the location and condition necessary for it to be capable of operating in the manner intended by management, and therefore could be capitalized as part of the PP&E. The committee noted from the facts of the case that the insurance premium has been included as part of approved or allowable expenditure under the various authority approvals and is hence an inbuilt element of the project cost and not an optional expenditure, and hence it was right to capitalize such expenditure. Perpetual lease of land, the underlying asset being land which has an indefinite life, the perpetual leasehold land had to be recognized as a right of use asset with an indefinite life. A long-term lease of land is sometimes regarded as being economically like the purchase of land. Consequently, some stakeholders suggested that long-term leases of land should be excluded from the scope of IFRS 16. However, the IASB decided not to specifically exclude such leases because A, there is no conceptual basis for differentiating long-term leases of land from other leases. If the contract does not transfer control of the land but gives the lessee the right to control the use of land throughout the lease term, the contract in effect is a lease and should be accounted for as such. And B, for long-term leases of land, for example, 99-year-old leases, the present value of the lease payment is likely to represent substantially all of the fair value of the land. In this case, the accounting applied by the lessee will be like accounting for the purchase of land in any case. However, if the lessee obtains control of the land, it will account for the contract as a purchase of land by applying Ind AS 16, property, plant, equipment, rather than Ind AS 16. Moving on to disclosure of impairment loss on long-term investments, this is often a matter of discussion and debate as to what gets classified as exceptional items in the India's world, given that the global IFRS literature discourages items being classified as exceptional. However, the disclosure of impairment loss, the EAC believed, could be an exceptional item, as the guidance on exceptional talks of two aspects, one, materiality, and the incidence of occurrence. If both these aspects are satisfied by the company, it is right for such losses, be it on impairment of the long-term investment, to be presented as an exceptional item in on the face of the income statement. Last but not the least, the accounting treatment for CCDs is again a matter which is contentious from an Ind AS 32 standpoint. What the company needs to assess is actually the substance of the contractual arrangement rather than the legal form. Therefore, it is possible for an instrument that qualifies as equity for legal or regulatory purposes to be classified as financial liability under Ind AS. It is often seen in case of CCDs, the ratio of a conversion shall be dependent on the share price of the company at the point of conversion. The equity conversion feature can only be settled through issue of equity shares. However, there is an obligation to issue a variable number of shares, as the number of shares is determined only basis share price on conversion. In other words, the conversion price and hence the conversion ratio of CCDs into ordinary equity shares of the company is not fixed at the point of initial recognition of CCDs. Therefore, the conversion component within the instrument would not meet the criteria laid down under Ind AS 32 to classify such instruments as equity instruments. Overall, the CCDs would not meet the criteria for being classified as compound instruments either, as there is no equity component. In such cases, the CCDs should be classified by companies as financial liabilities in their entirety. High quality disclosures and the importance of the same cannot be emphasized enough, especially in the current environment, to enable users to evaluate the nature and extent of risks the entity is exposed to. Regulators have consistently emphasized the importance of high quality disclosures. To this end, the Institute recently issued the India's disclosure checklist to facilitate the presentation and disclosure of financial statements. The Accounting Standards Board has issued the Ind AS disclosure checklist to help entities identify relevant disclosures required under Ind AS to prepare their financial statements. The checklist, of course, is a ready reference for disclosures, and it contains all amendments made up to March 2022, which are effective from 1st of April 2022, i.e., for the current financial year. The checklist, however, contains only disclosure requirements. Therefore, it should be read together with the standards, regulatory requirements, and related guidance material. So with that, we draw close to this episode of InSync. I hope you found it useful and a timely reminder as you gear up to close the financial statements for the year end. In case of any queries, please write to our email ID displayed on the screen, marketing@bdo.in. Until next time, thank you. Take care.